So, David, you are from Best Stock Strategy. We are both option sellers. My name is Mike. I am from HiQ Trading. And yeah, we're just here to discuss our strategies, bounce ideas off each other back and forth. So, I guess I'll just start with basically my experience and what I've been doing recently. So, I started, investing in the stock market the day I turned 18. That was about 5.5, 6 years ago. I just started as a dividend investor, just starting off in the stock market, didn't really know what I was doing. Eventually, I was on YouTube. I discovered options trading. And like most new option traders, I started with buying options. Did okay. I actually did decently well buying, but I realized it didn't seem very consistent. Felt like more of a casino, as I'm sure you're aware of that as well. And
Yeah.
so I started getting really into more statistical trading and selling options premium. I came across your videos on YouTube, helped me a ton. I've learned from Tasty Trade, Option Alpha, and the HiQ community in which I work for. Voice call there every day. And yeah, that's pretty much my experience. I've been selling options specifically for, I would say, 3 to 4 years now, or something like that. So been going pretty well. I'll just let you go and introduce yourself as well, David.
Sure. My name is David Jaffe from beststockstrategy.com. I have a YouTube channel at youtube.com/beststockstrategy. I worked as an investment banker on Wall Street, which probably has less to do with trading than many people realize. And then I transitioned from investment banking more towards option selling and trading and investing. I tried everything from day trading to buying options to aggressively selling options and buying long equity, short equity, etc. And I would say about 8 or 9 or 10 years ago, I switched solely towards selling options, and I've been just making small tweaks and modifying and constantly improving the strategy since I started.
Amazing. Yeah. So obviously you both sell options and mainly on the put side for me at least. I know you're kind of both on the call and the put side. I was just watching some of your videos again. One of the things that I really like that you do is that, you'll wait for security to sell off and then you sell a put option to simulate a long position. And then if the you don't because you don't like the delta neutral stuff instead of strangles, you would rather wait for it to sell off, sell a put, and then, if it increases and goes in your favor, and then you would turn around and sell a call. I think that's something that's really cool that you do. And for me, I like to stay mainly on the put side. And then if I get, tested, like I've been selling puts on the stock like SoFi recently, it went from 25 all the way down to 14. I've been short, 17 and a half and 15 strikes, this whole time. But since, I could have been long equity. I'm long equity at 20 plus, and then I'm pretty much just holding the stock, hoping it goes back up. What I've been doing is that since I've been selling put options as a long position, I've been able to take, my 17 and a half strikes, and now they're all the way down, at 16 and 15 strikes. So I've been able to reduce my cost basis and my risk while collecting premium the whole time. Which is, the beautiful thing about selling options is your ability to adjust, especially when things go against you. As long as theta keeps working for you, and if the stock keeps going lower and lower, I mean, you can easily, you start at 7 days, you sell a 17.5 strike, it gets tested, you roll it down to like a 16, 15. Even if that goes in the money, you're basically just long stock, and I'm completely fine with being long stock in all the companies I sell puts in. I think, that's a very important concept to be. And yeah, so what have you been trading recently, David?
Well, before we move on, just a few quick
Yeah.
things. So regarding the selling with strangles, I definitely believe that it's okay to be opportunistic when you sell strangles, because the
Mm,
way that I trade, I try to wait for what I perceive to be price extremes. So in that
gotcha.
situation, inherently, if I sell a put, it's a bad time to sell a call, especially on a market leading stock, which has a very high market cap, because generally speaking, those type of stocks tend to, if they overcorrect on the put side, then they tend to be like a rubber pin and snap back really quickly. Like, for example, Amazon, which fell to slightly below 3,200 just a few weeks ago,
Mhm.
and then it popped up to around 3,500 up around 10% in just a few weeks. So when it's oversold, it has a tendency to overcorrect to the upside as well and snap back very rapidly, which means that if you're selling a put option when Amazon fell to 3,200, let's say you sell to 2,800, you would probably sell around like the 3,400 call option, because if you sold something higher than that, you really wouldn't receive much premium. And then what many people who would do that, when they would sell a strangle, they would end up finding themselves challenged on the call side. So I'm completely okay with selling the put side when Amazon is below 3,200, waiting for Amazon to go up 10% in 2 weeks, in which case it's probably a little overextended on the call side. And then you can sell like the 3,850 or the 3,900 on the call side. So that way you have a strangle, but you didn't put it on as a strangle. The second thing, when you were talking about SoFi, I'm not that familiar with the stock, but you mentioned that you're short, like you were short like 17 strike. Is that what you said?
Yeah, so when I first started trading SoFi, it was above 20. It's currently, I think, at like 14 to 15 range. But yeah, I was selling 17 and a half strikes and then 15 strikes. I kind of like to spread them out a little bit. And yeah.
Sorry to interrupt. How did you, so if you were initially short the 20 or around the 20, how did you then, obviously, like you extended the duration, but what did you do how did you collect premium and then allocate that premium towards reducing the strike of your original position? Did you then sell additional puts? Did you sell calls? Like, can you walk me through the machinations and what you did in order to reduce that strike?
Yeah, 100%. So one, I never had 20 strikes. So I was never short of 20 strike. It was over 20 when I sold the 17 half. And the fifth, yeah. So I was selling the 17 halves. Everything was great. It was staying above 20, collecting premium, as we know. And then as it started selling off, I started adding a little. I didn't have a full position on, so I started adding more. I just started selling more puts at lower strikes, the 15 strike they ended up being. And so, yeah, basically I currently have, so I started with the 17 half. I sold the 15s, and then the 17 half is the one I was really kind of managing, because that was one that was getting tested, right, going in the money. And the main thing I did, I haven't sold any calls just because the stock has been already pretty beaten down. And again, I don't even like
to just what, like I said, like you don't want to go up to 22, 23 in a week and then get challenged on the call side.
Exactly. And you're collecting maybe $10 to $15 in premium for selling a 17 half, call, which is, I mean, fine if it stays below there, but it's just not worth it in my opinion, since I have a bullish bias on SoFi. But mainly what I did, so I sold more puts at lower strikes, and then I also just extended the time, I like to start selling options with, probably 2 to 4 weeks max expirations. Recently, I've been trying to stay 2 weeks or less, because when you have an option that's 2 weeks or less, it's a way easier to roll to a lower strike, given you extend the duration.
That's an incredible observation, and you're 100% right. The shorter the duration, the easier it is to roll to a more favorable strike price. Whereas if you have something with a DTE of like 60 days, you're going to end up having to roll it out to like 120 days. Whereas if you're short something that expires in 2 weeks, you can roll it out by an incremental 2 weeks and significantly reduce the strike price. So
Exactly. 2 weeks and less, like there's so little extrinsic value that, the strikes that are, like you said, 2 to 4 weeks out in time, I mean, there's just so much more premium in there. So if you wanted, you could easily take that 17 half and then roll it down to like maybe even a 15 for a couple bucks down at least, while still collecting a small premium, if anything. And the cool thing too is that, when the stock starts selling off, usually the IV goes up. Yeah. Which, it helps you in the long run as well in that sense. I know you like to sell calls, right? When, kind of things like, in order for you to roll down your strikes, you'll sell a call to finance going lower on the put side. Is that right?
It depends, really. Before we get into that, I just have a quick question on SoFi. So for that position, when you were short like the 17 and a half, or the 17, whichever the strike was, 17 and a half or so.
Yeah.
Let's say it expired in like 2 or 3 weeks. the 15 strikes and that you sold, were they more short dated? Were they like 1 week or 2 weeks, or did you have the same expiration? Did you match the expiration of the original position?
To be honest, I can't recall if I matched it I think I did match it exactly because back then SoFi didn't even have weeklies. Like I started trading as IPOE when it was a SPAC, and that's actually when I was trading. I started trading it, and then it turned into SoFi, and then that's when it actually started coming down a little bit. But just in general, whenever I open positions, I try to keep it, depending on the premium, 2 weeks or less, because that way I would much rather open something 2 weeks or less so that I can roll it down to a lower strike in the future, as opposed to selling like a 45 to 60 days out. And then if it goes against you, I mean, you can kind of manage it, but at the same time, it's just so much easier to start with a weekly, in my opinion, just because it's so much easier to roll it down. Like when you go out further in time, like yeah, you can sell further out the money and collect more premium. But I would rather sell the weeklies, and then if it gets tested, then that's when I roll out to a monthly to a lower strike, if that makes sense.
Yeah, and and are you selling naked options or spreads mostly?
So it depends. It depends. So all my positions, I have the cash to back them up. So I'm not using margin. The only time I would ever, consider using margin, I like to be cash secured, meaning I can be assigned all the puts until the market crashes, and then that's when I would be comfortable using more margin. But in my opinion, if you have a bunch of short puts and you're not able to buy the stock upon a correction, then you could be left, potentially getting a margin call if you're not safe. So that's why I would prefer to stay cash secured and then wait for the VIX to rise a lot and stocks to sell off a lot, and then if you want to, you can sell an extra put for that probably really good premium if the stock market's correcting 20-30%.
So just to bring something to its logical extreme, if your expirations are shorter than typical, which when I would say typical, my expirations usually, I would say they're about 4 to 5 weeks.
Yeah.
Sometimes I will go out pretty far. Like for example, in MasterCard right now, when it's trading at 340, and I think it's a great opportunity because just a few weeks ago it was trading at about 401. Which I think around 401.50 is closest is around its 52-week high, and currently trading at about 340. So in that situation, I want to take advantage of the high implied volatility and then the IVR. So then I will stagnate and sell, pretty much as many expirations as I want. But as far as like the way that you trade, if you're selling such short expirations, I don't know if you said 7 days. Do you sometimes sell 7 days?
So when I pick strikes, it honestly all depends on the annualized return / premium per day. And I've noticed, depending on the stocks, so the lower volatility stocks like MasterCard and Visa, they usually have better profit per day, premium per day, whatever you want to call it, annualized returns in the 3 to 4 week cycles. But these mid caps that are a little bit smaller market cap that have more volatility, the premium per day is actually better 1 to 3 weeks out that I've noticed. And so really at the end of the day, I look at the chart, I pick a strike that I'm comfortable buying the stock, and then I compare the premium per days for all the expirations. If I won't like the main thing for me is the strike selection. As long as I'm okay with owning at the strike that I'm selling, then it's great. And then all I have to do is compare how much premium per day each expiration will give me for that one strike, and then I'll sell the most opportunistic one.
So what about like zero DTE? Have you looked into that?
I'm not a huge fan of 7 DTE just because they're good because you can roll them out really easily, but it's
zero. Did you say 7 DTE or 0 DTE?
Zero. Right? Yeah. I actually, I sold a put in Coca-Cola. It might have been 1 DTE, and then it was like a 56 strike, and it immediately got tested, and so I had to roll it, down to like a 54 or whatever, and I ended up getting out for a profit. But I just, again, if the premium per day is the highest for a 0 DTE for the strike I want, then sure, I'll definitely sell it. But for the most part, I've noticed that the premium per day usually is the best, 1 to 4 weeks, depending on the stock. So.
And why don't you, I assume you have margin on your account, right?
Yes, but I don't prefer to use it just to sleep better at night. If I were to use margin or like wanted to like reduce, like get more buying power, I would just simply buy, some really cheap out of the money options to make it
I
a
don't,
spread.
for me, so when you buy when you buy stock on margin, your your buying power is reduced by about 50%. For me, like one of the best things about options, and I know that it's a double-edged sword because it cuts both ways, is you're able to control a decent amount of stock and use leverage. But if you're just using like half secure puts and you're also trading naked so that you're getting a large buying power reduction, if I were to trade cash secure puts, I would actually primarily trade spreads because that way my buying power would be consistent with the buying power reduction for regulation T. Um, I don't know. I mean, if
Yeah.
it,
No, yeah, that's honestly pretty much what I do. Like for I'm pretty conservative, especially when the market's at this high, or just where it's at, anything could happen. And like I said, like I don't like using margin at these levels. However, if, one starts, because I know when VIX expands, all my cash secured puts are going to be, probably tested, even go in the money. And it just makes me sleep better at night knowing that no matter what, I can't get margin called. And I know that since I have, so much buying power on the table, since I'm cash secured, when the VIX does do that, I'm game. I'm going to start selling put credit spreads. I'm going to start collecting those high premiums. And I think that'll make up for, the missed out gains that I have trading a little more conservatively right now, if that makes sense.
and regarding your strike selection, and then I'll go into an example.
Mm-hmm.
When you're done with this question, I'll walk you through an example of like what I did because you asked me a question a few minutes ago about like selling calls, but can you walk me through like a typical strike that you would sell for? I'm not really familiar with SoFi. I don't know
Mm-hmm.
its recent trading ranges, but maybe something like Amazon or Facebook or MasterCard or Visa or one of the or even Tesla or something like that so that um, I can get an idea for how you choose your strikes or
Yeah.
things like yeah.
Yeah, for sure. So if I was, I trade like, I'm actually in an AMD put right now, and what I did, so I mean, I do use a lot of technical analysis. I use volume profile in my charts. I use, just basic stuff, nothing too crazy with the technical analysis, but that's mainly how I pick my strikes. If I see a point on the chart that's been reacted to a bunch of times, uh, or even like Visa and MasterCard, those are two great opportunities recently. I bought some shares of Visa, but if I were to trade I don't have my chart pulled up right now, but I
So
would say
through walk me through MasterCard because I'm familiar with the price action on that.
yeah.
Like right now, so MasterCard, its 52-week high is around like 401.50. It's currently trading at about 340. It's been trending down over the past few weeks. What strike would you sell now approximately?
If it's at 340, here I'm pulling up my program. But what I would do essentially, I'll look at the chart, I'll see where like previous support was, and then I'll use that as a base, and then I'll go to the options chain and be like, all right, how much premium can I get for this strike? Generally I like it to be at least 5% out of the money, but with these low volatility stocks, it really honestly depends on the premium. Like I know I said strike's probably the most important thing, but if you're not getting any premium for the strike you want, then it's not worth it, right? So, yeah, I'll basically like I just put on my chart. Let me pull up Mastercard right now.
Now,
Um,
I'm assuming because you want to go like 2 weeks out, you're probably going to have to sell a relatively aggressive strike. I would think probably the lowest would be 315, probably more so 320 if you're going to sell
mhm.
2 weeks out to even make it worthwhile.
If I were to trade Mastercard right now, I would want to sell the highest I would go is 330. And I would probably somewhere in the 325 range, I would say. But then, let me go trade here and check the premiums for MasterCard. If I can't get anything for a 320, which actually you can get somewhat decent premium. So that about 2 weeks out, the 17th September, the 325 strike's gone. It's
It's,
about 13% annualized return, which
how,
is
what's the mark on it? What's the bid ask?
For 17 September 325, it's a buck 54 at the bid for that put.
It's a lot. Yeah.
It's not bad. Yeah.
That's pretty good.
Yeah.
So, okay. So to walk you through the, when you asked me about like selling calls and stuff. So an example, I guess, would be something like Alibaba, where about maybe 6 or 7 weeks ago, it was trading above 200. It was trending down, and then it was trading about like 202, and then it fell to about like 193, and then it fell down to like the low 180s, and then it popped back up, and then it fell. So when it was trading at about like 183, I then sold a 160 put option because I think that its 52-week high was around like 320.
Yep.
So I figured that, okay, in like the worst case scenario, I can sell a put on Alibaba. And even though I don't take ownership of stock, I figured that, okay, this is a pretty good entry point where it's below its 52-week high, and I feel pretty comfortable. And in the worst case scenario, I can roll this out. So I think my initial strike price or rather my initial expiration was about 3 to 4 weeks out. Then what happened was Alibaba fell, and I think it actually fell below 160, but I try to roll things like before it gets challenged, or rather roll it before it becomes in the money, because when you roll it before it becomes in the money, it's much easier to get a more advantageous roll. So when Alibaba was trading at about like 163, 164, I then rolled it out in time pretty far out, I think by about a month, to the 140s, to the 140 strike. So I gave myself a decent amount of safety net by rolling the 160 all the way to 140. Then I just simply waited. And then Alibaba traded to about 170, 175. At that time, when it had gone up over 10% in just a few days, I then felt that it was a great opportunity to sell calls. So during that situation, when you could pick up a decent amount of call premium, I then sold the 195 calls with very short expirations, about 7 to 10 days. And I collected that premium, and I used that premium to roll down some of the positions from 140 to 135. And what will likely happen is that if Alibaba continues to increase in value, I will then continue to sell short-dated calls. And instead of rolling down the strike price, I'll use that call premium to then reduce my expiration and bring that position in. Because one, Alibaba is not a core underlying. When I sold it, I just simply didn't have that many trade opportunities. And maybe I was a little bit too anxious that I wasn't trading often enough. So I kind of like forced the trade because I felt that it was a good opportunity, since Alibaba a few months ago was trading, like it was trading close to its 52-week high, and now it was trading close to its 52-week low. So I kind of forced the trade. So when a position gets challenged, my first goal was to get rid of it ASAP. And now that it seems like Alibaba has stabilized, I want to wait for those calls to expire. And then I'm going to keep selling far out of the money calls with short expirations. And then I'll just simply roll in my short puts, and then hopefully just get rid of the position.
When you say roll in, are you like rolling up in strike?
No, so.
Oh, well, it's a closer expiration.
Yeah, so closer expiration. So I think my expiration now in Alibaba is about like 75 days or so. So I'll just keep rolling it in by like a few weeks, have it potentially expire probably around early October. And by doing that, maybe, well, it's already September, so I don't think I'll be able to get the early October, but probably the mid-October, I'll be able to get it to expire.
Yeah, I could definitely see that. Baba, just the stock in general in China just scares me right now. So I haven't been touching it personally, but I commend you for doing it because their premium is probably amazing at the moment. And as long as the stock doesn't get delisted, I mean, you're collecting plenty of premium, so you'll be able to get out of that just fine.
Yeah, it was definitely a mistake to trade it. Even if I make money on it, then I still believe it's a mistake simply because it just simply wasn't worth the stress. Now, the way I look at it is now China's situation actually bothers me more for the United States' future than it does for China. I mean, I've never been to China. I don't really know much about it, but Alibaba is like a 400 to 500 billion dollar company. So I doubt that it's gonna like get delisted and like go bankrupt. It's a legitimate company. So, there are tons of institutional investors and hedge funds there. So I'm not concerned about that. What I am concerned about, though, is the fact that the two largest economies in the world are at complete polar opposites with regards to stock market valuations, where the United States continues to go up and hit 52-week highs, and China is close to a 52-week low. And I don't think that that's going to continue. So either China is going to increase in value and the valuations are going to increase, or the United States is going to decrease in value. But I just don't foresee a future where the two largest economies are trading at polar opposite ends of the spectrum.
No, yeah, I totally understand. I totally get that. And you make a good point, China's downtrending, we're uptrending. They're probably going to end up diverging at one point. And definitely Baba, the fundamentals of that company are amazing. I'm pretty sure they're better than literally than like Amazon even. So they're an amazing company. It's just, I guess, the politics, that's scaring everybody pretty much. But yeah, so what other stocks have you been trading recently? I know you're in MasterCard, Baba.
Previously, I was trading a lot of Amazon, but now
Nice.
not so much. I was contemplating last week selling calls on Amazon because I felt that it had gone up too quickly. But the majority of my portfolio right now is primarily in past positions in Amazon. I have a very, very large position in, well, I wouldn't say very, very large, but I would say that the majority of my portfolio right now is in Amazon and MasterCard because I perceive those to be the best opportunities. I just have a few contracts on Baba. I use that as an example because that's pretty much the only position that I have right now, which is being challenged. I mean, I guess potentially Zillow. I think I have like one or two contracts of Zillow with a strike of 80,
Mm-hmm.
and that's it's 20% out of the money, but still
I see.
Zillow trading at about like 96. And
Mm-hmm.
but yeah, the majority of my portfolio is concentrated in short puts on Amazon, which I might sell some additional calls on it if Amazon continues to go up because it's gone up from like 3,200 to close to 3,500, and then also Mastercard.
It's amazing, man. Yeah, my portfolio. So I don't try to avoid, like, I love Amazon, Google, all those great, top five companies. But I try to trade at least at the moment, since I don't have a multi-million dollar account or anything like that. I trade like smaller stocks. That's why I think SoFi personally is, the fundamentals are pretty solid in my opinion, and they're really low strike, and their IV is good. So I think that's one of the best opportunities literally on the market right now. Personally, I've been trading Corsair Gaming, another fundamentally strong company, great revenue growth, positive EPS. They've been growing really well. I've just been selling. Corsair is a great one too. That's even challenged me recently too. We can talk about. I started on Corsair. I've been trading it the whole year, and it's been kind of taking some heat recently, just like SoFi. But I started selling, so it's at $28, 28, $29 right now. It recently tested 25. When I started trading it, the stock was well above 30, and so I was feeling really safe selling 30 strike puts. And then slowly it just kind of kept consolidating 30 to 32. I was making premium. Everything was great. And then recently it started selling off and started testing 25. And luckily, I was able to roll down my strikes and reduce my risk. So now currently I have a 27.5 and a 25 strike that, I'm short right now, which I was able to advantageously roll down from 30. So I felt pretty good about that. Just reducing my risk there.
So you feel that fundamentals of a stock are important?
Oh yeah, yeah. I think, I mean, I wouldn't trade anything that I don't believe that's going to be around long term, or at least they at least have to be, making money, positive EPS or revenue growth or anything like that. Just, I think it's important just as,
Revenue is not okay, but that's different than like cash flow. I mean, for someone like myself who is extremely familiar with fundamentals, because that's what we price companies off of when I worked as an investment banker. It was pretty much all comparable company analysis and like enterprise values at LTM EBITDA. So like the last 12-month cash flow. I'm just interested in knowing why when you're trading like in the stock market, why you believe that fundamentals are important.
I just believe that, you know, there's stocks on the market that are fundamentally strong and there's stocks in the market that are not fundamentally strong. And I just avoid the ones really that aren't fundamentally strong. It's almost like a filter, you know, just kind of like, I know you only trade like the market leaders and whatnot. What I like to do is just avoid stocks that aren't fundamentally strong, if that makes sense.
So if you perceive a stock to be fundamentally strong, but then the market does not, then you believe that, so you would be okay with like sticking with a stock and then sticking with your observation that no, the fundamentals of the stock, which are historical in nature, whereas the stock market is like always forward looking in nature, then in that perspective, you would still say, no, the historical fundamentals on this stock are valid and they're great. So I believe that the stock market is mispricing the stock and I'm going to stick with it.
I wouldn't even say it's necessarily mispricing the stock. I just try to find the best stocks to sell premium on at the end of the day, you know. And in my opinion, if you want to find the best stocks, I personally think it's just better just to find the ones that are fundamentally strong, at least at history, you know, like, I mean, you can just go and trade Apple, Microsoft, yada yada. Everyone knows those stocks are going to be around for a while. I mean, but the thing is, you never know the stock market. You know, like GE was like the #1 stock in the S&P, but even that is, you know, it's been selling off a lot recently. So even if, like, you're right, even if the stock is fundamentally great, you know, it's top 10 S&P, you never know. Like, it could be irrelevant in the next 20 years.
Yeah, like IBM, I think in the early 90s
Yeah.
was this company. And really, I think one of the only companies in recent history that I could recall that stayed extremely relevant has probably been Microsoft, where Microsoft was extremely relevant from, you know, the mid 1990s, which was even before like the internet boom, and they've continued to be like the elephant in the room even up until now. So
No, yeah, for sure.
but I just think it's interesting. I wasn't trying to like push you, or because I was like genuinely interested in your observation of like the fundamental analysis. I just think that the stock market is driven so much so on emotion, where you look at a company like Amazon. I mean, they weren't profitable for years, and then I think that the majority of their income in like the early 2010s came from like AWS or Amazon Web Services, and now I believe, you know, I'm pretty sure that they're profitable. I don't look at like any 10Ks, Qs, but I'm assuming that they're profitable. You know, even if you took out the AWS income, but then even if you look at something like Tesla, I view something like Tesla, and I think that maybe they're profitable based upon like the carbon credits. That's kind of like and I've done very well with Tesla, but I kind of feel like it's like a cheerleading stock where people get sucked into a leader who is very charismatic. And you know, I'm a big fan of Musk. He's an innovator, but at the same time, you can look at the fundamentals and say, oh, okay, there was no reason why on January 7th or 8th of 2021, Tesla went up like 17 or 18% in those 2 days. That doesn't make sense, but it still happened. So if you were short that position because you felt that from a fundamental perspective that Tesla was overvalued, suddenly in 2 or 3 days, people are going to vote with their pocketbooks, and then that position moved against you by over 15% in 2 days in early January 2021. So I tend to be like, for me personally, I tend to be pretty careful about, I don't even really look at fundamentals, and I try to gauge what the overall sentiment of a specific stock is.
Okay.
And then I also do look at the market cap, because it just takes significantly more money to move a stock like Tesla or Amazon or Microsoft than it would to move a low cap stock, which can be manipulated quite easily with just like a few $1 billion of institutional funds.
No,
So
yeah, no, I like that. That's a really fair point. But I have another question for you. So I know you like to trade the market leaders, but at the end of the day, if you don't care about fundamentals, then why wouldn't you trade, some of these smaller stock? I guess, okay, so you look at market cap. So when you're screening for stocks, you look at pretty much the same 10 to 15, and what you look for is high market cap so that it doesn't move as much. Is that basically it?
no, not really. I think, to be honest, it's just, I feel like the more money is chasing a stock, the more eyes are on that stock, the more efficient the markets are. I don't need to read any articles. It's just much more efficient. The markets are tighter, the bid-ask spread, the slippage is less.
Gotcha. Yeah.
And also, I don't need to read anything about Amazon or Tesla or Visa, MasterCard or JP Morgan or anything like that, because there's so many people institutional investors, retail investors who own that position where everything, all the news is already priced in. So I don't need to do anything. I
Yeah.
just need to observe the price and then make an observation and make a determination similar to what you said a few minutes ago about the premium that you receive. And if I feel that a stock is either overbought or oversold, I'll choose a strike price that I don't believe is going to get challenged. And then I'll look at the premium that I can receive. And if I think that premium is worthwhile to compensate me for my perception of the risk, then I'll make that trade. If I don't, then I'll pass.
No, that's great for sure. Yeah, yeah. No, I like that a lot. But I mean, I guess you could make the argument too that if all these institutions are in the stock, then they're probably not in the stock where their fundamentals are bad, like they're buying the stock because they see the future growth potential and because that they're making consistent money, they have predictable revenue and stuff like that. But no, I totally get what you're saying.
I guess so. I mean, you can also, I mean, institutions obviously they make mistakes. But the fact is that I do think that if a company is worth hundreds of billions of dollars, then you have enough people and enough institutions in there who you would assume have done their diligence, unless it's like outright fraud, like a WorldCom or
Yeah.
Enron or something like that, which I don't think that Amazon is in danger of going bankrupt. I mean, we use their products; they have tangible assets.
No,
So
I'd agree. I wouldn't like worry about them going bankrupt. But at the same time, if the market's crashing, all stocks, including Amazon and even like recession-proof stocks, I mean, they're gonna still correct. I do like your argument about the market cap though, since all these institutional guys are in there. It's gonna be less volatile and less, easy to manipulate than the smaller cap stocks that I like. That. Another thing though is that the premium, because the safer a stock tends to be, the less the premium is going to pay you, right? Because less people are speculating and buying puts and worried about the stock crashing because of that. So
say
it's kind of a trade-off.
say that once more.
So the safer a stock is, like for example, a stock like Coca-Cola, their premiums are much lower than a stock like SoFi or a smaller to mid cap stock, because so you're basically compensated less for the risk.
Right. But be careful with that, because you're kind of conflating the perception of safety with the market cap, and that's not accurate. So, for example, if you have a company something like Tesla, which has an expected move, historically, it's always had like a pretty high expected move. So earlier in 2021, the expected move on something like Tesla, which at that time was valued at about like 350 to 400 billion dollars, because the expected move was so much, there was extremely high IVR and extreme large amounts of premium available.
Yeah, I wasn't
So,
talking about market cap specifically. Sorry to interrupt.
so just because a company might have larger market cap, that doesn't necessarily mean that I mean, you know what I'm saying? Like, it doesn't necessarily mean that you're going to collect less premium. I think that the premium is really all baked into the expectation of the volatility. So I think just for me, I tend to avoid the smaller caps, and also like I'm pretty risk averse. Like, if you look back, okay, so March 2020, I personally don't think that we're going to experience something similar to that. And the reason is that we've never experienced anything even close to that in the past, where the violence of the move was condensed to such a small window. I think it was about like 36% in like 33 days. So I actually lived through and was working as an investment banker back in like 2008, 2009.
Mm-hmm.
And yeah, the market fell like 56, 55%, but it happened over the course of like a year and a half. Um, I, and even in that situation, the reason I'm bringing this up is Amazon fell from about like 32 or 33, and I think intraday it hit a low of about like 2,200. So right now, when Amazon was trading below like 3,200, I could sell using portfolio margin puts on Amazon because it had pretty high implied volatility, right? Because it had fallen from about 3,750 about like 2 months ago all the way to about 3,200. I could sell the 22 or 2,300 using portfolio margin,
Mm-hmm.
which is probably more than like 3 standard deviations out, and collect. At one time, we were collecting about $10 a share, and it was barely using up any buying power, like $6,000 of buying power reduction for collecting like $1,000 by selling a naked put in Amazon using portfolio margin. So, and the reason why I chose that strike was I figured, okay, in the absolute worst case scenario, I could roll this put down to about 1,800. And in that case, it's kind of like, oh, I might as well just take ownership of it because I want to own Amazon at 1,800 so that I can participate in the upside, considering that just a few months ago it was trading at like 3,750. So I guess, and my level of comfort when trading Amazon and going pretty large by selling those out of the money, far out of the money puts is it gives me a level of comfort and not a significant amount of stress. Whereas if I was selling something that had a very small, or not very small, but like a smaller market cap where I was like more concerned, and I don't think I would trade it as large, or I wouldn't be as comfortable, and then I would probably end up, making less money because I would be more anxious about the position.
Yeah, that's a fair. I like that, but the only thing I don't not necessarily disagree with, but you said it's using a small amount of buying power because it's so far out of the money, right? But it's a small amount of buying power until it's not a small,
Yeah.
But
Yeah,
then you said and then you said you have the money to buy the shares, which is great. I mean, at that point, is if you have the buying power, it's no worries. But if your account's allocated, 50, 60%, and you only have 20% of the money to buy the shares, worst case, you're what, like $6,000 of buying power, your strikes in the money. Now it's like, who knows, $100,000. So I've always, like,
yeah,
when I first started trading strangles, that's one of the things I didn't like. When I was like still new, I just went at it. I was like, oh, $600 buying power, that's nothing, right? I can add another position until one of the strikes gets challenged, and now your $600 of buying power is like $3,000 of buying power per strangle, and you're just like, well, it seems like I'm over allocated at this point. So
that's a great point. So
yeah.
let's say, just going back to that example, um, let's say I was short. Let's say just I try to be like very, very conservative. I don't know if you watch like the monthly videos that I put out that show all my
Hmm.
trades. Like I trade pretty. I would say almost every trade I make has a has a probability profit of like over 95% or so. But let's
Nice.
say I made a mistake, and let's say I traded too large. So let's say Amazon was trading at 3,200, and I just said, no, I'm going to sell those 22, 2,300 puts because I believe in it really strongly and there's high premium, and I just traded way too large. And then let's say the market started tanking and I just got really unlucky. What are like some things that I could do to protect myself from that happening? And like, can you just can you walk me through like what you would do, or
So basically, if you started selling a put and then the market started coming down, essentially, or
Mhm.
yeah,
Yeah,
so yeah, so what you can do, I mean, the first thing I'm gonna say is buy some puts, but at the same time, I don't like that because if you sold a put and you're getting tested, you don't want to be buying puts necessarily. So my first thing I would say, roll down and probably out in time to give yourself a better strike. Um, the thing is like so if I sell a put and it gets challenged, that's like the worst thing because I don't like selling calls and I don't like selling puts after I'm getting challenged. Um, so what I try to do is I try to stay with like I said the weeklies, and then worst case gets challenged, you roll it down and out. Even you can if you want. So one of the things I like to do is buy like really cheap out of the money puts. For example, like not even because I hate buying options, so like I'll try to like spend as little money as possible buying the puts just to like have some security, because even like you buy a put that's worth literally $5, like it's $5 insurance, but if the stock really tanks, the option go from like $5 to $100. Like that's how you can get, uh, both sides of like you're selling premium, you're selling more premium than what you're buying, so that's good. But you can still capitalize on huge down moves to the downside. And if you're long some puts, then you can have like 100% gain winner on like some long put that you got. So
what I would do is and obviously and actually the biggest contingency or the biggest factor in this is actually what you said earlier, and I think that was an amazing point because in many of my other discussions that I've had with people, they haven't mentioned how sensitive an option price is based upon the DTE. So a lot of it is contingent upon the days to expiration. But what I would do, let's say I just got caught and I got unlucky and I traded too large, and I hope that what I'm about to say doesn't give people like a false sense of security and say, oh, I can just do this and manage the position, and therefore I'm going to trade larger from the onset. But what I would do is so figure if the market was trading at about when Amazon was trading at about 30, 300 and like 3,200, I think the VIX at that time was trading at about like 20, and now it's like around like 16 or so.
mm,
So figure that if Amazon fell to about like 2,600, then the VIX would probably pop up to, I don't know, like 32,
mm,
33. So what I would do, let's say I was short like the 22 or 2,300 put option, I would wait for Amazon to fall to like 2,600. And then depending upon the days to expiration on that position, I would actually roll it forward probably by about like 1 or 2 months. And then
mm,
I would use that premium to actually reduce my position. So let's say I was short originally like 20 puts. If I rolled, and let's say the expiration was in like 2 weeks, right? If I
mm.
roll that position forward by about like 5 or 6 weeks, I could probably cut that position from like 20 contracts all the way to 8 would probably be too aggressive, but I could probably cut that. I could definitely cut that in half to about 10, and I could probably cut that to 8 if I slightly increase the strike price from like, let's say 22 to like 22.50 or something like that. So there are, and then and then in that situation, so that's what I would do just to make sure that I got my size in check. And then if the position continued to fall, this, let's say it was at 2,600, and then I rolled it to like 8 contracts at 2,250, or let's say worst case scenario, I had to roll it to 2,300. So then it fell like an additional 10 or 15% to about 2,200. Then I might consider buying an at the money put and then selling an in the money put, and because in that situation, I'm protected from future downside while I'm also able to participate in the upside gain.
Yeah, for sure. I definitely like that a lot. I just don't like being that like far in the money, just personally. So no, I totally get what you're saying though, because even though you're in the money, if you're owning an at the money put, then you're not really taking an insanely large amount of risk, especially if you're able to lower the amount of contracts too. So I think that's great. Yeah, I really like how you do that for sure. And then did you say you sell calls too to finance that, or you just kind of roll up and then reduce the contracts? Because if the stock is selling off that hard, then there's probably a good chance that the IV is going up a lot too, like you said. So you'll be able to collect a lot more premium at that time.
I would consider selling calls, but I would prefer to wait after it had kind of had like a little bit of an exhaustion, like up move,
Yeah.
because generally, and I mean, everyone saw this in late March 2021. You had like a V-shaped bottom where something fell from, like, Amazon was like at 2200 or intraday, and then like 2 days later it was at 26. So the last thing, look, the last thing you want to do when you're trying to collect a little bit of incremental premium to improve the basis of your short put position, the last thing you want to do is get challenged on the call side. I mean,
Yeah,
don't do it. So
I agree.
I really I like selling calls, but even the calls that I sell, they're further out of the money than the puts that I sell, because the market does have a tendency to go up. Now, if a call was to get challenged, I would feel more comfortable managing that, because the stock market doesn't necessarily crash up. It's kind of like that thing where the bull like takes the stairs up and then the bear jumps out the window. But because the market has a tendency to go up more than it goes down, I will sell a call like further out of the money than I would have put.
No, definitely. I totally agree. I would say I try to be like really safe. So at the same time, I'd say I'd sell equally as far out of the money for both, just to be on the safer side. But that's just me. But yeah, other than that, what was I gonna say? I had a question for you. Oh yeah, so I was gonna say too. So you said you don't like selling the calls, but at the same time, if you're rolling the strike, deep in the money, then you're being compensated a lot. And even if the call is getting challenged, let's say you have like 5 puts and then one
Yep.
call, you
Yeah.
still wouldn't be in the worst situation, right?
Yeah. You just close out the entire position, and you'll have made more money on the upside participation of the in the money put than you will of the current market price expansion on the loss on the call side.
Yeah.
Assuming that the call was far enough out of the money where the call isn't already in the money and it's not going up like pretty much like 1 for 1, or that the call doesn't already have like an extremely high delta.
Exactly. And if it's getting tested, your put's making tons of money. And if it still keeps getting tested, worst case, you can even just keep rolling the puts up. So I like that a lot. Another thing too, I'm just not a fan of selling calls in general, because, obviously the market tends to go up. But at the same time, I'd much rather get put debit spreads or even just long puts to hedge my short put positions, because if the market, does decide to tank, then those long put positions can actually be really profitable, right?
Yeah, you make money
Yeah.
on the volatility extension, right? Yeah, and
Yeah.
that's not a bad strategy at all, especially when the VIX is trading. Yeah, okay, so this is interesting, and this I'm sure I'm wrong on this, but so figure like January 2020, the VIX was trading at about like 13,
So
and like
low. Yeah.
like middle of February, because I think it started like falling around like February 19th of 2020. But I think actually that the current low in VIX of about like 15 is comparable to the VIX trading at about like 12 or 13 back in January of 2020. And remember that, like, if you study the markets and you're like a historian of it, like there didn't used to be like put call parity until like the
Yep.
huge crash in 1987, at which time after that, puts were, you could sell puts and get more money than you could with calls. And I think that because of the violence of the move in late February and March of 2020, I think that volatility, at least for a really, really long time, the floor of volatility is going to be elevated. So the 15s or 16s that we're seeing now, I think is comparable to like the 12 or 13. So I definitely think that selling, or rather that buying debit spreads right now is pretty damn good strategy.
Yeah, no, I totally agree with you. And I think one of the reasons for that is retail. Like I could be totally wrong, but people, almost anyone can open up a Robinhood account now and just YOLO their whole entire life savings on options. And literally people are doing that. And so there's so many more people buying options, I feel like that just generally they're probably priced higher. So I would agree. And also another thing, ratio spreads, I used to be a big fan of for sure, like selling two puts and buying one call or buying one put that's right above that strike. And something I like to do now, like let's just say I sell a put on like, AMD or whatever, and then that put I make money on the put. What I'll do is I'll buy a put debit spread, or in other words, I will. So I have the let's just say I sold a 100 strike put on AMD, and then I'm up 40%. I'll then go and buy one strike above it and then sell another one of the same strike. In other words, adding a debit spread, a put debit spread. And that way, if the market does start to come down, the put debit spread is actually, it can be like more of a positive theta trade at least than just a long put is. But actually, what I did the most recent, it was actually on AMD. Instead of adding a debit spread, I just bought a naked put and made it a one wide spread. So I went from having a cash secured put on AMD. I collected 30%, and then I went ahead and bought, like a 99 put or whatever, and now it's just a one wide spread with like a really good risk to reward in my favor. So I'm totally comfortable holding that. And even if AMD were to go, correct 40% tomorrow, I know my max risk is only like 30, $40 because I strategically entered into a long put, made it like a really wide spread, and then that way, like I know like you use like portfolio margin, but since I don't, and I'm just cash secured, that's like a good way for me to free up buying power, I would say.
Yeah. Do you so going back to the Robinhood, do you think that a lot of Robinhood traders are using debit spreads, or do you think that they're more kind of like YOLOing by buying call options?
I think most are doing just buying naked options.
Yeah.
Yeah, for sure. Because I started on Robinhood, started trading on there because I downloaded like the day I turned 18. That was like right when Robinhood came out, and literally like you don't need anything to be able to trade options on Robinhood. Like you just turn it on, and so like yeah, to get spreads though, there is like a tier 2 or tier 3 or whatever on that. But yeah, I think mostly people are just buying naked options and just gambling for the most part,
Yeah, it's just
especially in like AMC and like all that.
I know with a lot of my students, sometimes they get rejected from some of the legacy brokers. Like I know Schwab is like very difficult to get approval for like level 3 and level 4. Fidelity is very difficult for level 3, level 4. And then you have something in the middle where for Tastyworks, they pretty much approve everyone for the works, which is fine. They have like some screening, and then Robinhood, like it seems like they really approve like everyone to trade. I find that a little bit interesting where some of the legacy brands like Schwab or I don't know how difficult E-Trade is, but yeah, they just make it like much more difficult, which I think causes them to lose out on some of like the young traders, which could
That's
potentially hurt them in the future.
Yeah. Well, the thing is, Robinhood, they don't allow anybody, to my knowledge, to sell naked calls. So you can sell options if you have like the highest tier, I believe.
Oh,
But it has to be cash secured puts or a covered call. So you can't sell a naked put and you can't sell a naked call, but you can buy naked options as much as you want. Which I mean, it kind of makes sense because
yeah, it's limited risk.
yeah, limited risk. I mean, when you're selling, like, it's probably not a good idea to give, some random kid on Robinhood the ability to sell naked calls, even though it's probably a better strategy than buying a naked call. I think it's just riskier for Robinhood because, I mean, you could probably picture it now, just people selling, like, just doing dumb stuff, what people do, and, like, getting caught in, like, in a short position that they can't afford and, like, going negative and stuff like that. So I get why Robinhood only allows you to buy options, but I think it's really kind of bad or not. It's good for us because I mean it makes the premiums higher, I guess, but it's
Yeah,
not good. for the people trying to learn how to trade, and they're like, oh, buying options is safer. I'll start like this, because they make you buy options before you sell options, which is one thing
Yeah,
I hate about it.
it
Yeah.
encourages you to buy options, and I think I said this in a video like 2 years ago, where it 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 encourages bad habits. And yeah, I mean, what are your thoughts about buying options?
Buying options. Okay, so I'm okay with buying options as long as there's collecting more premium than you are buying premium. So like put credit spreads or call credit spreads. So I think any option you buy should be covered, financed by an option that you've sold, if that makes sense. So like a
Yeah,
put credit spread.
that way, like you're not paying all the extrinsic. At least it's it's buffered slightly, or you're selling some of the risk by selling the option. The spread.
Exactly. Like worst case, you're not. Worst case, you're still net selling premium. But I think like if you collect a bunch of money on like a short put, I think it's fine to buy a long put and make it a put credit spread after that, because you've already essentially paid for the long put and you're kind of protecting yourself, and you're still long or net collecting premium at the end of the day. So like it's not like you're just gambling and you're going to lose it all. Like you still like paying for the option with the ones that you've already sold, basically.
So you're saying like, let's say you were to sell a put credit spread, and then you would allocate some of that premium towards a long call option to finance it.
I don't. I would say like if I would start by selling a naked put, and then if the trade goes with me for me, I collect premium out of it. I'd be okay spending that profit, not necessarily on the call side, probably more on the put side for downside protection. Because
Oh,
yeah. hmm I mean, yeah, you could spend it on calls too. That's probably not the worst strategy. If like
yeah,
the market, yeah,
I think that's great, and I really respect that your thought process is like that, because so many young traders, they would double down, and they would actually allocate that premium towards buying calls, because their goal is to like hit home runs and grow a small account as quickly as possible. Where I think one of the amazing things that which makes you wise beyond your years, and why you're going to be very successful in
thank you.
whatever you do, is you're always trying to protect the downside risks. So I think that's fantastic.
Yeah, that's really the main goal, because I was trading a lot of spreads and iron butterflies and I was kind of just playing around during some expansion events, and I was like, wow, like I'm like it's easy to make money selling options, but once the VIX expands, that's like when it really gets like that's when you need to know what you're doing for sure. And yeah, so I think protecting the downsides always should be definitely the number one. I know you say that all the time too, and I couldn't agree more for sure. Yeah.
Cool, man. Anything else?
Um, no, I think we covered a lot today. Yeah. Anything else you want to say?
No, I think that this was really beneficial for everyone. I like sharing my knowledge. As I said, I really respect that someone like yourself who's so young, and I feel very similarly with JC Gilbert as well, because he's very young too. I think that you guys, who are like in your early 20s, you're really the future. So I think that
Eh,
setting a good example and setting a good precedent, so that you encourage people to hit singles and not try to hit home runs at the risk of striking out, is really the best way to go. And I know that it's not sexy to hit
Yeah.
singles and to make like a few percent every single month, but I really think that long term, your bank account will thank you if you try to hit singles as opposed to always trying to hit home runs.
No, I totally agree. And what I'm doing right now, so I am, pretty younger. I don't have the largest account like you do yet. So like, once I have, a multi-million dollar account, then yeah, I'm just gonna sell puts on the SPY, Google, Amazon, all that. But right now, I am trying to grow in the safest way possible, if that makes sense. So that's why I do kind of like trading, these small to mid cap stocks, because the premium is nice. It's lower strike prices that I can sell, so it's easier for my account size and stuff like that. And I think it's the safest way to grow in the fastest way possible. Like it's like you gotta, at the end of the day, you want to make money. You want to build your account. And if your account's too small to be able to trade, cash secured puts on Amazon and stuff like that, I mean, you gotta improvise a little bit,
Yeah, definitely. I mean, use like pretty narrow credit spreads or
Yeah.
things like that. I know it is harder when you're trading a smaller account. You have to be much more judicious in your capital allocation. I would also, if I was trading a smaller account, close out trades more aggressively and faster, so that way you can allocate the capital to new opportunities. It's more work, but at the same time, it is important to establish good habits.
Yeah, I was gonna say. So I mean, I could just go long, these stocks, get the equity, try to grow my account that way. But I'd rather, sell puts, be able to continually lower my basis, because I think at the end of the day, that's just what's going to benefit you is the basis reduction in these stocks. Is at heart, I'm like a long-term investor. I have a dividend investment portfolio aside from my options portfolio. Um, so but like you said, it can't. You sometimes got to improvise. You got to close positions out early, use wider spread or closer spreads and stuff like that. So yeah. But once I'm making 1% a month on like a $50,000 to $100,000 isn't sexy. But if you're building a skill, once you have the account to do it, to make 1% on like $1 million account, you're in a whole different ball game, right?
Last question. So let's say your target is like 1 to 2% a month, right? And
Hmm.
let's say you weren't teaching people how to trade and you were just trading for yourself. Approximately how many trades a week would you make? And I understand that this is just an estimation. And how much time would you spend trading in order to earn that like 1 or 2% a month?
Yeah, so I used to trade 30 to 45 day options a lot, and now I trade more of the weeklies, which increases the time I have to the amount of time I have to roll trades and manage them and keep an eye on them for sure. I mean, trades per week. I mean, it would depend on the stock, of course, just how much the buying power I have. But God, I mean, I would probably like I'm on the market on the voice call at Haiku all day. But if I wasn't teaching people, I would probably only trade for most 30 minutes per day. And then kind of just manage. I would check it like throughout the day on my phone and stuff, and just keep an eye on it. But as far as like trades, I mean, I only trade like 3 to 4 stocks, and I probably make like 1 to 2 trades a day. Just rolling them, managing them, closing out for profit, opening up a new one. And probably the most time consuming part is finding new trades, finding stocks that are selling off. So,
So let's
yeah.
say 45 minutes a day estimation, like all on your phone, right?
Yeah, I could do it on my phone. I do prefer my computers because it's easier. But yeah, you could easily do it on your phone. Max 45 minutes a day. Like I said, the most time-consuming part is finding the new trades. But once you have them in there, I mean, as long as you know what you're doing and you know how to manage them, the stock sells off. Oh, cool. It's my strike's in tested. I'll just roll it down. Cool. I'm done for the day, right? So it doesn't
Yes.
take that much time.
So that's like 3 hours, 45 minutes a week for, an incremental, let's say like 20% a year.
Hmm.
Um, I mean, that's pretty good. That's kind of like the definition of like a pretty good side hustle, right?
Oh, 100%. I easily think this is the best side hustle. The only thing you need is the money to do it. But other than that, like, there's nothing better that I think it's the best skill that people can learn. Like, yeah, I mean, it seems really like time consuming and hard at first. I think people get scared of options because, I mean, you see these people, gambling their whole portfolios and it looks scary. And I understand why people would be hesitant about it. But at the end of the day, I think it's literally one of the best skills that you could teach yourself, and I think for your future financial self that you should definitely look into selling option premium 100%. So,
Yeah, I definitely
yeah.
agree.
Yeah, for sure.
Okay. So, yeah, I think that's a great call. Is there anything else that you want to say?
I think we're good. Yeah, we covered a lot. It was really great talking to you, David. Really great talking to you for the first time. I've been started emailing you maybe like a year ago after COVID, and just we emailed back and forth. It was really cool to talk to you for the first time.
Thank you. It's been my pleasure. I always love talking to you. You're very introspective and you have great takes on things. And yeah, I appreciate it. So thank you for having me and for asking me, and for having us be on this call. I learned a lot as well. And yeah, I hope to speak with you soon.
Yeah,
Thanks
I hope to
again.
speak